Right now, as these words reach you, a reservoir of physical silver valued at $1.3 trillion has been withdrawn from the global supply chain, sealed into sovereign reserves, long-term industrial offtake agreements, and strategic allocations where ordinary market forces cannot touch it. In the silver market, the thinnest, most explosive, and most unforgiving arena in all of finance, stands directly in the path of the consequences. The speculators have already departed. The paper futures complex is a ghost town echoing with emptiness, yet the price continues its quiet ascent. Someone, somewhere, has read the signals with clarity, and in the minutes that follow, you will read them too. But the detail that alters every assumption, the one no mainstream outlet has yet confronted with the seriousness it demands, is this: the freeze is not approaching. It is already complete. Welcome to the unseen economy, where the most consequential shifts in global finance receive the measured, unflinching analysis they require. If you have followed this channel across any meaningful stretch of time, treat the subscribe button exactly as you would have treated consistent pension contributions at the age of 35. You would not have skipped that obligation then. Do not skip it now. One deliberate tap, because the weeks ahead will reward those who position themselves with eyes wide open. And while the button is in front of you, leave a comment. Tell me the city, the country, the continent from which you are watching these words. London, Lagos, New York, Nairobi, Canada. This narrative is not confined to any single nation. It is everybody's story. It began without sirens, no emergency press conferences, no breaking news crawls, no panicked alerts across financial television. Just quiet, persistent transfers executed with the patience of institutions that plan across decades rather than quarters. Right now, inside the controlled vaults and binding contracts of nations and entities that think in generations, $1.3 trillion worth of physical silver sits secured, every single ounce removed from the available pool, every future claim on it extinguished. It is not leveraged capital-chasing returns. It is deliberate, strategic procurement. The scale is 3 times larger than the locked silver positions visible before the 2008 global financial crisis brought economies to their knees. 3 times larger than the strategic accumulations that preceded the dot-com collapse and the evaporation of trillions in paper wealth. 3 times. And yet, almost no one in the corridors of conventional financial commentary is treating this development with the gravity it commands. To grasp what this truly means, one must first understand the mechanics of a frozen silver market at this magnitude. Silver occupies a unique position in the financial universe. It is simultaneously a monetary metal with centuries of history as a store of value and an industrial necessity whose demand grows structurally every year. When that metal is removed from circulation at sovereign scale, the effect is not gradual erosion. It is immediate, compounding, and self-reinforcing. The remaining ounces must now satisfy 2 relentless masters at once: the ever-expanding industrial appetite driven by solar panel manufacturing, electric vehicle production, advanced semiconductors, medical devices, and defense electronics, while simultaneously absorbing the monetary flight capital that always seeks hard assets when paper promises begin to fray. The pool shrinks, competition intensifies, and the mathematics of scarcity begin to assert themselves without mercy. The historians who study financial dislocations will tell anyone willing to listen that the absolute quantity locked away matters less than the speed at which it vanishes. When silver is frozen at this level, it does not disappear in slow drips. It vanishes in decisive blocks. One major sovereign allocation triggers parallel moves by others watching the same data. That allocation tightens available supply. That tightening lifts prices. That price response draws fresh attention. That attention accelerates further procurement. The loop does not wait for permission or external validation. It feeds itself. This is the first wave already underway. The systematic removal of metal that leaves the paper market with nothing left to sell into the vacuum now forming beneath it. Now the silver dimension reveals itself as the critical fault line. When the inevitable liquidation wave from leveraged equity positions begins, it will not encounter the elastic physical supply that once absorbed shocks and contained volatility. The metal is already spoken for, already allocated, already removed from the liquid pool. The futures complex, already hollowed out to levels not witnessed in 2 decades, will confront surging demand with no corresponding inventory available to meet it. Forced selling will dismantle the very paper mechanisms that once operated to suppress true price discovery. What remains is a physical market staring directly at scarcity it cannot easily resolve. As this is the first impact, not a crash from panicked selling, but an explosion from absence. After the initial wave of liquidation passes and the dust begins to settle, capital does not simply evaporate into the ether. It migrates. It searches for the single asset that cannot be conjured into existence by central bank decree, cannot be erased by software update or policy announcement, and cannot be diluted by endless issuance. It searches for silver. And here lies the distinction that sets this cycle apart from every previous episode. The market that must now absorb that migrating capital is already operating on the thinnest participation seen in a generation. Speculative involvement has collapsed. Open interest on the primary futures venue has fallen 40% in just 18 months. The trading floor is quiet. $1.3 trillion in silver now sits frozen beyond ordinary reach. A monetary metal market functioning with minimal depth and almost no speculative cushion. And a convergence of pressures that no credible forecaster is comfortable extending much beyond the next 30 to 60 days. Imagine stepping onto the main silver trading floor of the world's most important futures exchange and encountering near total stillness. No raised voices carrying across the pit, no flurry of orders shouted from one desk to another, only the soft electronic hum of servers and a scattering of participants moving with deliberate, almost cautious precision through what was once a cacophony of activity. This is not a hypothetical scenario. This is the current state of the COMEX Silver Futures Complex in the spring of 2026, and the emptiness carries implications that extend far beyond any single trading session or quarterly report. To appreciate why this emptiness is more than a curiosity, one must understand the precise function this venue serves. It is the daily arena in which the global benchmark price for silver is discovered through the continuous interaction of futures contracts. It is the place where bets are placed, where leverage is applied, where institutional sentiment finds its most visible expression. When participation is robust and open interest is high, the market possesses genuine depth and resilience. It can absorb large movements without fracturing. When participation thins dramatically, that resilience evaporates. Open interest functions as the market's vital sign. It counts the number of outstanding contracts at any given moment, each one representing a committed position, each one's skin in the game from a participant with capital at risk. High open interest signals vitality and engagement. Low open interest signals withdrawal and disinterest. And over the past 18 months, that vital sign has deteriorated in dramatic fashion. 18 months ago, open interest stood comfortably above 185,000 contracts, representing a vibrant, contested, and well-participated marketplace with hedge funds actively engaged, algorithmic trading systems running at full capacity, and speculative capital flowing freely across the complex. Today, that figure hovers near 115,000 contracts, a 40% reduction in engagement, not because silver suddenly lost relevance or utility, because the fast money community found louder, easier, and more immediate opportunities elsewhere. In technology stocks riding momentum waves, in currency plays offering quick volatility, in any asset class where short-term profits could be extracted without the patience required for physical markets. They left silver behind to those who measure time in years rather than weeks, yet the price has refused to obey the textbook script. With fewer participants in the futures market, conventional wisdom and every historical precedent across commodity markets predicts softening prices, wider spreads, and increased downside volatility. That pattern has held true time and again. Silver violates it with unusual consistency. The year opened with prices near $32 per ounce. It surged to extraordinary levels during the geopolitical strains of late January. It has since consolidated but continues to hold and grind higher, sitting now in territory that would have seemed ambitious, even unrealistic, just 12 months earlier. Price ascending while speculative participation collapses. These two conditions should not be able to coexist unless another buyer has entered the picture, and not through the paper futures mechanism at all. Through the physical channel, actual metal changing hands, bars and coins moving into allocated storage accounts, long-term procurement agreements locking supply for years ahead. The evidence of this buying appears with clockwork regularity in the timing of price action. Strength and firmness during Shanghai trading hours, continued upward pressure through Beijing market sessions, stability across Singapore, then a noticeable fade or sideways drift once Asian markets close and Western desks assume control. This is not random statistical noise. This is a persistent, observable pattern. And patterns in financial markets that endure across months are never random. They are signals. They reveal who is accumulating when they are accumulating, and more importantly, why they are accumulating with such quiet, deliberate, and consistent discipline. A ghost town in New York, silent, methodical accumulation happening overnight in the East. And $1.3 trillion in silver now, sitting frozen, waiting for the moment the pressure finds release. The vacuum is forming, and nature, as it always has throughout history, will find a way to fill it. There is an old and reliable principle in financial markets that serious money never announces its presence. It does not hold press conferences. It does not publish its strategy in prominent financial newspapers. It does not appear on television to explain its rationale. Serious money moves quietly, deliberately, and with extraordinary patience. It accumulates in the shadows while the rest of the world remains distracted by louder, more theatrical developments. And by the time the broader market finally realizes what has occurred, the position is already built, the price is already adjusted, and the opportunity has already passed for everyone who was not paying attention. That principle is executing now in the silver market with a precision and scale that is genuinely remarkable. And the actors behind this accumulation are not the ones most Western investors would instinctively expect or monitor. To understand who is buying and why, one must first step back and examine the larger geopolitical and monetary realignment that is quietly reshaping the global financial architecture in 2026. Because this accumulation of physical silver is not happening in isolation. It is not the random investment decision of a few wealthy individuals in Asia. It is part of a deliberate, coordinated, and strategically motivated shift in how certain nations and institutions are choosing to store, protect, and project their wealth into the future. For decades, the global financial system operated on a simple and widely accepted assumption. The United States dollar served as the unchallenged world reserve currency. American financial institutions were regarded as the most trusted custodians on the planet. The assets held inside American vaults, including the gold stored at the New York Federal Reserve on behalf of foreign nations, were considered absolutely safe, absolutely accessible, and absolutely beyond any serious question. That assumption is now being tested in a very public and very uncomfortable manner. France changed everything. Earlier this year, French financial and political officials began raising serious, pointed, and increasingly public questions about the gold their nation holds inside the New York Federal Reserve. They were not asking politely or in private diplomatic channels. They were demanding clarity, precision, and verification. They wanted to know the exact physical location of their gold, the precise condition of their holdings, and whether an independent third-party audit could be conducted to confirm that what France believes it owns inside that vault actually exists in the form and quantity recorded on paper. The response from American authorities was not reassuring. The questions were deflected. The audit requests were complicated by layers of bureaucratic procedure. The answers provided raised more concerns than they resolved. For serious observers of the global financial system, this was not a minor diplomatic inconvenience or a temporary communication glitch. It was a signal, a clear and unmistakable signal that the trust, which held the post-World War II financial order together, is developing fractures that may not be repairable through simple reassurance or procedural delay. And France was not alone in raising these questions. When sovereign nations begin questioning whether their gold actually exists where they were told it exists, the logical next step is not to wait patiently for better answers or more comfortable assurances. The logical next step is to begin acquiring hard assets that they can hold directly, store domestically, and control completely without any dependence on foreign institutions or governments whose reliability has come into question. Gold is the obvious first choice for any nation seeking to diversify away from paper promises, but gold is expensive, widely watched, and immediately noticed when sovereign buying begins at meaningful scale. Silver is different. Silver is smaller in unit size. Silver is cheaper per ounce. Silver moves under far less scrutiny. And silver, in a world where industrial demand is already structurally growing through solar panel production, electric vehicle manufacturing, and advanced electronics, carries a dual value that pure monetary metals do not possess. It is simultaneously a monetary asset with historical pedigree and an industrial necessity with no easy substitutes. For a nation building infrastructure, expanding manufacturing capacity, and reducing dependence on Western financial systems, silver is not merely a store of value. It is a strategic resource with both defensive and offensive characteristics. This is what the accumulation data is reflecting with increasing clarity. During Shanghai trading hours, physical demand is consistent, disciplined, and persistent. It does not spike dramatically and then disappear. It builds steadily, session after session, week after week, month after month. The buying has a patience to it that is characteristic of institutional or sovereign actors operating on a long timeline with a clear strategic objective. This is not speculative trading chasing short-term price moves. This is procurement executed with the discipline of statecraft, and the West remains structurally blind to it. Western financial media is built almost entirely around paper markets. It tracks futures contracts, monitors COMEX positioning reports, analyzes hedge fund flows, and measures sentiment through instruments that exist entirely within the American and European financial ecosystem. When physical metal moves through Asian markets, when sovereign entities accumulate silver through channels that never touch a Western exchange, those transactions are largely invisible to the analysts and commentators who shape mainstream financial opinion. The result is a profound and dangerous information gap. Western investors are looking at a ghost town on COMEX and concluding that nobody wants silver. Eastern institutions are looking at the same market and seeing the opportunity of a generation. One side is reading the paper market and walking away. The other side is reading the physical market and accelerating its accumulation. History has a consistent and unambiguous record on what happens when these two perspectives finally collide. The paper market eventually reconciles with physical reality. It always does. And when that reconciliation happens, it does not occur gently or gradually. It happens suddenly, violently, and with a speed that leaves most observers with no time to respond or reposition. Every financial crisis in recorded history has had a moment, not a week, not a month, but a specific, identifiable moment, where the pressure that had been building silently for months, sometimes years, finally exceeded the capacity of the system to contain it. The historians who study these events always note the same pattern afterward. The warning signs were visible. The data was available. The logic was clear to anyone who was genuinely paying attention. But the majority of investors, business people, and decision makers were focused elsewhere, distracted by noise, reassured by the fact that the system had not broken yet, and therefore assuming it would not break at all. That assumption is the most expensive mistake a serious investor or entrepreneur can make. And right now, in the spring of 2026, that assumption is being made at an extraordinary scale. To understand why the next 30 to 60 days represent a window that serious decision makers cannot afford to ignore, one must understand the concept of a trigger point. A trigger point is not the root cause of a financial crisis. It is the moment when an existing cause, already present and already building pressure, finds the specific condition it needs to release. The fuel does not need to be added at the moment of ignition. The fuel is already there. It has been accumulating for months. The trigger is simply the spark that allows the accumulated pressure to express itself. Right now, there are 3 specific trigger points that analysts tracking this situation are watching with considerable concern. Each one individually carries significant weight. All 3 arriving within the same narrow window creates a scenario that the silver market, in its current depleted and thinly participated condition, is structurally unprepared to absorb. The first trigger is the margin debt unwind. $1.3 trillion sitting in leveraged margin accounts does not require a catastrophic market collapse to begin unwinding. It requires only a sustained and meaningful correction in equity markets. When equity markets fall with enough consistency to push margin account values below required maintenance thresholds, the calls begin. And as established in the earlier analysis, those calls do not stay contained to the stock market. They force liquidation across asset classes, including precious metals in the first wave. That forced selling creates temporary downward pressure on silver, but it also destroys the paper positions that were suppressing silver's true price discovery. When the dust from forced liquidation settles, the physical market reasserts itself with a force proportional to how long it was suppressed. The margin debt is not a question of if it unwinds, it is a question of when. And with silver already substantially frozen and removed from the liquid pool, the effect on remaining available metal will be magnified beyond anything seen in previous cycles. The second trigger is the dollar confidence fracture. The questions France raised about New York Fed gold holdings did not disappear after they were asked. They circulated through sovereign wealth management communities in Europe, the Middle East, and Asia. They reinforced a concern that had already been growing quietly for several years. If the world's most trusted financial institution cannot provide transparent, independently verified answers about the assets it holds on behalf of foreign nations, then the foundational trust that gives the dollar its reserve currency status is not as solid as the official narrative maintains. When sovereign nations lose confidence in paper systems, they do not announce it publicly in advance. They act quietly, they repatriate, they diversify, they accumulate physical assets. The French situation was not the beginning of this process. It was simply the moment it became visible enough to be undeniable. And every week that passes, without a satisfactory resolution, adds weight to the concern spreading through international financial circles. That concern is now translating directly into accelerated physical silver procurement. The third trigger is the industrial demand collision. Silver is not gold. Silver does not sit passively in vaults waiting for monetary conditions to change. Silver is consumed. Every solar panel installed on a rooftop somewhere in the world uses silver. Every electric vehicle rolling off a production line contains silver. Every advanced semiconductor, every medical device, every defense system component that requires electrical conductivity draws from the same physical silver supply that monetary buyers are now competing to accumulate. Global solar installation targets for 2026 are running ahead of schedule. Electric vehicle production numbers across Asian manufacturing centers are breaking quarterly records. And the silver required to meet this industrial demand is coming from a supply chain that has not seen meaningful new mine development in years. The physical market was already tightening before sovereign accumulation accelerated. Now, both forces are pulling from the same shrinking pool simultaneously. The industrial demand is not a projection. It is already happening. The numbers are already in the data. And with $1.3 trillion already locked away, the competition for what remains becomes acute. Consider all 3 of these triggers arriving within the same 30 to 60-day window. Margin debt beginning to unwind forces liquidation, and then capital flight into hard assets that are already in short supply. Dollar confidence fracturing at the sovereign level accelerates physical silver procurement by institutional buyers who are already accumulating. Industrial demand continuing to consume physical supply from a market that has no surplus inventory to absorb additional pressure. Three forces, one thin, depleted ghost town of a market. The mathematics of this situation are not complicated. They are simply uncomfortable. For the business community, for serious investors, and for the young entrepreneurs watching this analysis, the strategic lesson here is not about silver specifically. It is about what this moment reveals about the larger financial architecture of the world in 2026. The systems that the previous generation built their wealth assumptions around are under genuine structural pressure. The dollar's unchallenged dominance is being questioned at a sovereign level. The paper markets that were supposed to provide price discovery are running on empty. The physical assets that governments and institutions quietly trust more than any digital balance sheet are being accumulated at a pace that the public narrative has not yet caught up with. The serious decision maker does not wait for the mainstream narrative to catch up. By the time it does, the window has already closed. $1.3 trillion in silver now sits frozen beyond the reach of ordinary market forces. A futures complex running on the thinnest participation in 20 years. Sovereign and institutional buyers accumulating physical metal with quiet and deliberate consistency. Three trigger points converging on the same narrow timeline. The system did not break today. It did not break this week. But it is not the same system it was 12 months ago. And the investors, the entrepreneurs, and the business minds who understand that difference, who act on that understanding before the broader market is forced to confront it, will look back on this window not as a moment of crisis, but as the moment everything changed. The floor is already shifting beneath the financial world's feet. The only question that remains is a simple one. Are you standing on solid ground? Thank you. See you in next one.